Okay. So under the what are the things that we are going to be looking at? What will be the scope of the 16, the IFRS 16 that we are going to be doing? So we are going to try to do everything under the IFRS 16. So if you come to the IFRS 16, okay. So if we come to the IFRS 16, which is the leases, okay, we will try to look at what we call the lessor accounting. Okay, so we come to look at how the legitimate owner will account for the arrangement. We also come to how the lessee, okay, how the lessee will also account for. So the person that the right to use the asset has been transferred to, how is he or how is she going to account for that particular one also? So we'll be looking at the lessee accounting also. So we'll be looking at the lessee accounting also. Then we come to what we call, we look at the lessee accounting. Then we come to what we call the foreign lease. Okay. So the foreign lease, what we are going to be looking at is that a lease has been, the asset has been leased from a foreign company, which is going to be in a different currency. Okay, how do we go about it? You are in Ghana, you have now leased an asset from a Nigerian company. The two of you are having different currencies. How do you account for this? So we are going to be looking at that one also. Then we will look at what we call a modification of a lease, okay, or a modification of a lease. If you talk about modification of a lease, we'll be talking about issue of increase in scope. So we'll be talking about reassessment of the lease liability. Okay, so the modification can lead to an increase in scope, which we call the reassessment of lease liability. So we now reassess the lease liability. Okay, so we reassess the lease liability. We reassess the lease liability. Okay, which will always be an increase in scope. Okay, what do we call an increase in scope? An increase in scope will be a situation where you have entered into the agreement and the rate implicit in the lease was 5%. Now it has been increased to what? 6%, or it has increased to 7%. Okay, the increase in our scope can also be the lease period has now been extended. There was an option to extend, but at the date of the arrangement, there's no condition saying that the option will be exercised. Now the option is now exercisable. So how do? We have to reassess our lease liability. There can also be a situation where you are occupying what? The first floor of the organization. Now you want to extend it to the second floor. So you want to now add additional what? Units to the arrangement. So you can enter into an agreement with a company to use their assets. Okay, at a point in time, you want to now increase the number of assets that you are going to be using. So that will also be an increase in scope. That will also be an increase in scope. There can also be a situation where the lease rentals will now be increasing. So if you are adding additional asset to it, we first of all look at the arrangement to see whether the asset that you are adding is a distinct asset or is an asset of the same nature, or is an asset that can be negotiated in the same way the first arrangement has been negotiated. So if you are using plants and you want to add additional plants, that is an increase in the original arrangement. But if you are using plants, now you want to use what? Building. These are two what? Assets. So we have to account for each of them as a separate what? Arrangement. Okay. So the modification can also lead to what we call a decrease in scope. How do we account for the decrease in scope? Okay. So there can be a decrease in scope. How do we account for it? The decrease in scope means that you are now occupying 100% of the what? Of the structure of the building. Now you want to reduce it to 70%. That will be a decrease in the scope. You have rented or you have leased what? 3 properties or 3 vehicles. Now you want to reduce it to 2. That's a decrease in the scope. The lease was for 10 years. Now you want to reduce it to what? 7 years. That is a decrease in scope. How do we account for it? If you count the decrease in scope, there is an issue of we having what we call profit or loss. So we have an issue of determining either there will be a gain on the arrangement or there will be a loss on the arrangement. But anything that is going to increase in scope, what we do is that we just reassess the liability and do the transaction between the right of use and also the lease liability. Okay, so the decrease in the scope is something new that we are coming to do, and you also have to pay attention that whenever we do something new, you might see it in the exam. Okay, so last sitting we did sub lease where a company has taken you have rented out a property and you have also decided to rent it out to another person. Okay, so that was something new that we did last sitting, and in the July exam that it was there. So you have to, whenever we are doing something new, you have to be very careful with it. So the decrease in the scope is something new that we are going to be doing, and it's going to be very simple. There is no issue about that. Okay. So before we start, this is what we are going to be looking at. So we can't do anything more than this one. So we are going to be looking at what we call lessor accounting this morning. So we look at what we call the lessor accounting. Okay. First of all, we need to understand what a lease is. Then we come to the types of lease and also the parties to the lease. Then we come to the accounting treatment. Okay. So the first thing that we have to know is what is a lease? Okay. What is a lease? What is a lease? A lease. What is it? Yeah, Senior Abeku.
A lease is a contract between two parties where one party agrees for the other party to use this property in exchange for consideration called rent.
Okay. Lease is an agreement. It's a contract between two parties. It's a contract between two parties. It's a contract between two parties where one party agrees to give out its assets or idle assets to the other party to use in return for a consideration which we call the renters. So if you are talking about lease, what we are just trying to say is that the lease is a form of acquisition. Lease is also a form of acquiring an asset, but just that at the end of the period or at the end of the contract, you might be purchasing the asset or you might be returning the asset to the legitimate owner. So what normally happens is that you have a car that you are not using. So you run a business and you have a delivery vehicle that you are not using. Okay, maybe you need money. You also need money to finance your operation. So what we do is that you now identify a company that needs the delivery van or the delivery vehicle, and they need it and you are not using it. So what will happen is that okay, you give it out to them. So you give it to them, but you're not going to give it to them for free. You are going to give it to them for a consideration, or they are coming to rent it. Okay, they are coming to rent it. So they will be paid. You give them the right to use the vehicle. So you giving the right to use the vehicle, they will now pay you a consideration which we call the renters. Okay. So if you talk about lease, we are just saying that it's a contract or it's an agreement between two parties where one of the parties is going to be giving out the right to use to the other party in a return for consideration. Okay, so you have a car. We don't have any direct relationship or we are not families. So I want to use the car. So you have given the car to me. I'm going to rent the car out. It means that you are leasing the car to me. Okay, you can give the car to me for a day. You can give the car for me. You can give the car to me for a month. Okay, you can also give the car to me for a year. Okay, you can give the car to me and you tell me that whatever is going to be happening, whatever happened to the car, I should call you so that you can come and take it and take care of it. Or you can take it to a mechanic and take care of it. You can also give me the car and add that, okay, whatever is going to happen with the car, I have the right to do it. So if the car develops faults, I'm the one who is going to take care of that one. So it can be a situation where the arrangement will be telling me that whatever happens to the car, I'm going to take care of it. Whatever happens to the car, you are going to take care of it yourself. Okay. So if you are talking about lease, the first thing that you have to identify is that you have to identify the asset in question, underlying assets. Okay. We have to identify the underlying assets. We have to identify the underlying asset. What assets? What assets are we having the arrangement on? Or what assets are we talking about? Okay. You cannot be there and be saying that the person is going to be, okay, we have entered into agreement that I'm going to give you an asset. I have not defined or I have not specified the asset I'm going to be giving to you. In that case, we can't say that is a lease. Okay, there is no identifying or there is no underlying asset in the arrangement. The asset that is going to be leased out have to be specified in the arrangement. Okay, this person is going to give you one of his assets. Which one is one of his assets? Okay, so there should be the underlying asset should be identified very well. Okay, and the party should be willing to give out the asset to you for a consideration. Okay, we can have an arrangement that I'm going to give you an asset at this particular period. Okay, and you are going to be paying this amount. How committed are we to that particular arrangement? Okay, so they can give you an example or they can give you a situation where they will be asking you to see whether there is a lease over there or there is no lease. Okay, there should be arrangement between two parties on a particular asset. The asset should be aligned. Okay, the terms and conditions of the arrangement should be clear. You are going to be paying this amount. The asset will be given to you at these dates, and you should also have the right to use the assets. Okay, if we have an arrangement that I'm going to be giving you an asset at these dates, and the asset has not been given to you yet, that is not a lease. There is no lease because I'm not using the asset. The right to use the asset has not been granted to me, and I'm not going to be giving you anything. Okay, so you should be very careful with the issue. They can give you calculation. They can also give you a theory question to identify whether the arrangement is a lease or whatever is going to be happening there. Okay, we need to have the name of the parties to the lease. So we have the parties to a lease. Okay, we have a party. We have the parties to a lease. Okay, which we are going to be calling. So the party to a lease, we are going to be having the legitimate owner of the asset, which we call the lessor. Okay, so we have the legitimate owner of the asset. Then we also have the lessee. Okay. Okay. Is that how you write lessee? I hope this is the correct one, isn't it? Okay. So we have the lessor, that is a legitimate owner. Okay. So this is the person who owns the assets. Okay. But this is the person who is going to be using the assets. So this is the other party other than the legitimate owner. So this will be the user of the asset from the arrangements. Okay. So the asset belongs to the lessor, and the lessee will now come and what and rent the asset. He is the one who is going to be using the assets. Okay, this particular arrangement, the lease can be more than half of the useful life of the asset. Okay, I can give you an item, or I can give you vehicle that is having 4 years. I can give it to you on rentals for 3 years. So you can see that this particular arrangement is more than half of the assets. I can also give the vehicle to you and say that, okay, at the end of the lease period, you have the right to or you have the option to purchase the you have the option to purchase the item. Okay, I can also give an item to where the lease that you are going to be paying, the present value of the lease that you are going to be paying will be equivalent to the fair value of the assets. I can also give the asset to you where maintenance, insurance associated with the asset will be transferred to you. So I'll be telling that whatever happens to the asset, you are going to be taking care of it. So if there is an accident, if there's any issue, you are going to be taking care of the maintenance, the insurance of the asset over the lease period. Okay, if the arrangement is like that, then we are going to be looking at the types of lease. So the types of the lease depends on the issues, which is the terms and conditions, on the issues to maintenance and everything about the asset. So we are going to be having what we call operating lease. Okay, operating lease. Okay, please don't say that operating lease will not be more than the useful life of the asset. No, you can even give us an asset on an operating lease for the entire useful life of the asset, which will be 50 years. Okay, so what will happen is that someone can just put up a structure and the person will rent it out to what? To the business people that will come, people will now come and be selling in the structure. They will rent it out and now put it up a store. So they will now rent the place and now put it up as a store, and they will be there for the entire useful life of the building. It doesn't mean that the operating lease is going to be for a short period. Operating lease can be for the entire useful life of the asset. But what makes it an operating lease? For the operating lease, there is mostly you will not be having an option to purchase. So after that one, you will not be having an option to purchase. There can also be an option to purchase, but mostly there is no option to purchase. Okay, what differentiates the operating lease from the finance lease is the issue of risks and maintenance. Okay, the issue of risks and maintenance. So you'll be saying that you'll be having a situation like, or you'll be having statements like the lessor has the right to, the lessor has the right to, so you'll be hearing that the lessor has the right to replace the assets. Okay, the lessor has the right to replace the assets or substitute the assets. So you'll be seeing question like the lessor has the right to substitute the assets. Okay, if you have issues where the lessor has the right to substitute the assets, that is an operating lease. Okay, because for the finance lease, the rights and maintenance has been transferred to the lessee. But if you have an arrangement where at any point in time after 2 years, the person will now come and replace the asset for you and give you a different one, that's an operating lease. Okay, so if you come to the risks and maintenance, and insurance relating to the assets, is still with the It's still with the lessor. Okay. Rests with the lessor. So legitimate owner. What will happen is that if you are occupying that particular building, if there's any crack on the building, you have to call the owner to come and fix it. Okay. If the lighting system is not working, you have to call the owner to come and fix it. That's what we call the operating lease. So the renting that we have been doing, it's only in Ghana that if there's a problem with the structure, the landlord will tell you that fix it so that I'll pay you. Okay, that is also an operating lease. So the renting that we have been doing is an operating lease. And operating lease mostly are treated as investment properties. They are treated like how we treat what? The investment properties under IS what? 40. Okay. Let's come to the next one, which is the finance lease. Okay. The finance lease. So we'll be looking at how we account for operating lease in the books of the lessor and also in the books of the what? The lessee. How do we go about that? So let's come to the finance lease. What is a finance lease? What differentiates finance lease is that the lessee has the option to purchase the asset after the what? The lease period. Mostly the asset is being leased out. Okay. Always covers the what? Covers half of the useful life of the asset. So you can be seeing statements like that. Covers half of the what? Half of the useful life of the asset. Okay. Okay. The present value of the renters, which is the lease liability, is equivalent to the fair value of the asset at the arrangement date. Is equivalent to the fair value of the assets. Okay. Fair value of the assets. And with this one, what happened is that, okay, what happened is that the risks maintenance, and insurance associated with the assets. Okay, associated with the assets. So anything about the risks and maintenance associated with the assets is transferred. Okay, is transferred to the lessee. Transferred to the lessee. What do we mean by this? Okay, this is the reason why we even recognize right of use when we are coming to the finance list. So what happened is that you are going to be maintaining the asset. Whatever problem is coming with the asset, you are going to be taking care of it within the lease period. So in this case, it seems like you are the legitimate owner of the asset. So if you come to finance lease, the risks, the insurance, and everything associated with the asset has been passed to what? Passed to the lessee. You can only take care of your own assets. You can only insure your own assets. So in this case, it seems like the lessee is the owner of the asset during the what? The lease period, because this asset is going to be giving you economic benefit over a particular period of time. You can also control the asset, how you are going to be using the asset, because you are going to be taking care of what? The asset in terms of risks, in terms of insurance, you are going to be doing those things. So it seems like the asset within that period, you are the legitimate owner of the asset. For that case, the lessee has to recognize what we call right of use. The lessee has to recognize the right of use, because insurance, risks, and maintenance associated with the asset has been passed to the lessee. You can only take care of what? Or you can only maintain an asset that belongs to you. You can only insure an asset that belongs to you. Okay, you can only bear the risks of your own property. So in this case, the asset is going to be seen as the what? As a property of the lessee. Okay, so for this place, we normally take into consideration what we call a substance over form. We apply the substance over form to the finance lease. Okay, over the useful life of the asset, who is going to enjoy the economic benefit of the asset more? Who is going to take care of the risk and the insurance of the asset? In this case, then this particular person has to recognize the right of use and also have to recognize the cash equivalent of the asset today. What do we mean by cash equivalent? You are going to be having an arrangement to be paying at the end of every year or at the beginning of every year. Okay, this amount that you are going to be paying over a particular period of time. The question is, if you have money to pay today, how much are you going to be paying? So we try to find the present value. Okay, the amount that you are going to be paying over a period, you are going to be taking some years to pay. So it means that you are keeping my money for some years. I have to consider what time value of money. Because if you give me the money today, I can use it to invest somewhere. I can use it to buy something. But now you are keeping it. I have to now add interest. so that the time that you are going to give me all the money, I can be able to buy what I want to buy. So there's going to be a time value of money. Okay. So if you are paying today, how much are you going to be paying? With present value, the all the amount that you are going to be paying. That is the cash price of the what? Or that is the cash equivalent of the asset. So if you should buy the asset, that is what you are going to be paying. And that is the value of the asset. So you recognize the right of use at the same time the what? The lease liability. Then we try to amortize, we try to calculate the interest element on the what? On the lease liability at the end of every year. Okay, that's what we do. But if you come to operating lease, we don't recognize right of use, although right of use will be granted to you, but it is not possible that you are going to be enjoying the economic benefits of the assets and the risk and maintenance. So you cannot insure. So you can only, if you are insuring, means that it is as if you are the owner, but there's no issue of insurance, maintenance, and what and risk transfer to what to the lessee. So operating lease, the only thing that the lessee will be accounting for is the renters as an expense. So if there's any owings of the renters, he is going to be recognizing that as what? As a liability. If there's any prepayment to the renters, he's going to be doing that as what? As a current asset or as an asset or as receivables. Okay. So we are coming to how, so we know that we have two parties to the lease. We are coming to what we call the lessor accounting. How does the what? The owner account for this particular arrangement? The accounting treatment depends on the type of what? The lease. If it is an operating lease, okay, if it is an operating lease, you see that the ownership will not be transferred to what? To the lessee for a particular period of time. So the lessor will still recognize the assets. Okay, the lessor will still recognize the asset in its books. Okay, and depreciate it over, recognize the asset and depreciate it over the useful life of the assets. Okay, over the assets, useful life of the assets. So what will happen is that the asset will still, the lessor will still be the owner of the asset. So the asset will still be in the books of the lessor. And the lessor will now depreciate it if it's a depreciable item. Okay. Or if the question is telling you that the lessor carry the asset at what? At fair value, then that will entirely be investment property. But if you come to the lease, the asset is being assumed to be carried at what? At cost model. So the assets, you are still the owner of the assets, but the people, different person will be occupying, but you are still the legitimate owner. You are still going to be maintaining the asset. You are still going to be insuring the asset. So you still keep the asset as your own and depreciate it over the what? Over its useful life if it's a depreciable item. So the lessor will recognize what we call, because the lessee will be paying what? Renters at the end of every month or at the end of every year. We don't know how it will be paid. Okay. So it can be at the end of every year or at the end of every month. So the renters that the person will be paying to you is a source of income. Okay, that is an income. So the lessor recognize what we call rental income. Okay. So the lessor recognize what we call the rental income. So any owings from the lessee or any prepaid from the lessee, any owings or prepaid or prepayments. Let me just say prepayments. Okay. Any owings or prepayments from the lessee will be recognized as a liability or an asset or a receivable. Okay. So any owings or prepayment from the lessee will be recognized as what? As a liability or asset. So if it is owings, the person supposed to pay you and the person is not owing you, your money or your property or your resources with the person. The company resources with the person. So that is an asset. It's a prepayment. The person has overpaid for what service that you are giving or for the service that you are giving to the person. So you now have the obligation to refund that particular money back to the person because that particular portion of the income is yet to be what? Yet to be earned. So you are having a resource that is not what? That is not yet earned. So that will be a liability. So it depends on what is going to be happening. Okay. But what will happen is that let me just use illustration over here because mostly the operating lease will mostly be covered under the what? Under the investment property. So you have an asset. So you have an asset. So the lessor, which is ABC Limited, okay, uh, leased out an asset which costs, let's say, 10,000 Ghana cedi to XYZ Limited on an operating lease on a 50, okay, let me just see, on, so on an operating lease should be on a 5-year, 5-year operating lease. Five-year operating lease. Let's say January 1, okay, 2021. Okay, so the okay the details. So let's see the details about the assets. The details is what we have the annual rental payment. Annual rental payment is, let's say, it's 10 cities in arrears. Okay. So the useful life of the assets, useful life of the assets, useful life of the assets, useful life of the assets at the date of the lease, let's say at the date of the lease is 10 years. Okay. So we can say that the, so we can also say that the, we can also say that, so there can be an issue of, there can be an issue of, okay, let's see, the lessor incur a direct cost, or the lessee can even incur the direct cost. If the direct cost is being incurred, how do we go about it? So the lessor or the lessee incur a direct cost of, okay, direct cost of, let's see, 2 million. Any of them is the one incurring the direct cost. Okay, so the financial year of the company is December each year. So how do we account for this one? Okay, so let's see how so we come to the lessee first. So we also talk about when there is a operating lease, how does the lessee account for the operating lease and even the direct cost? Okay, so what will happen now is that we are going to be having, okay, when a direct cost has been incurred, how do we account for that? So what we do is that for the year ended, so let's count to December 2021, which is a financial year end, we are going to be having, so let's say we have our statement of profit or loss. Okay, so we are going to be having a rental income. Okay, that is the amount that we are receiving from these people, and the rental income is 10 million. So we have the 10 million. Then we have a depreciation, okay, because the asset will still be in our books, which will be having, please, the asset is having a useful life of what, 10 years. So don't say that the lease period is what, 5 years, so you are going to depreciating the asset for over 5 years. No, the asset that you have purchased, you are going to use it for 10 years. Okay, so you still depreciate the asset over 10 years. The asset will still be used for 10 years. Okay, so you have your asset. So let's say the value of the asset is actually, so let me see, it's 100 million. Let me just mention 100 million here. So the value of the asset is 100 million, not even 100. 100 is too much. So let's have 80 million. Okay. So what you do is your depreciation will be the 80 million divided by 10 years. Then you'll be having 8 million as a depreciation every what? Every year. But let's come to the direct cost incurred by the lessor. Why are we incurring the direct cost? The question will tell you that the direct cost has been incurred to what? To make the asset ready for what? For use by the what? By the lessee. Okay, so the direct cost that we are incurring now, is it going to be over the entire useful life of the asset, or is it going to be over the lease period of the asset? That is the question. Why are we incurring the direct cost? The direct cost is not incurred to make the asset ready for use by ourselves. We are incurring the direct cost to make the asset ready for use by the what? By the lessee. So here is the case. The direct cost, is it going to be amortized over the entire useful life of the asset, or is going to be amortized over the lease period? Which of them? Which of the period are we going to be using? The direct cost that has been incurred to make the asset ready for use by the lessee. Is it going to be amortized over the entire useful life of the asset or over the lease period?
I think it's going to be over the lease period.
Over the what?
Lease period.
Okay. So it will be over the lease period because we are incurring this cost because of the lease arrangements. Okay. So if you are renting out and the door is 40, what you do is that you ask the person, how many years are you going to stay there? The person will say 5 years. So you fix the door to cover the 5 years. Okay. But if it is a cost that you have incurred to make the asset itself ready for use by yourself, it means that this particular cost is going to be over the entire useful life of the what? Of the asset. So you come to amortization. So you come to amortization of the direct cost. The direct cost, you are not going to expense it. It is a cost that is being incurred on an arrangement that is going to last for 5 years. So you amortize that over 5 years. So 2 over 5. And I'm sure that we are going to be getting 0. What? What are we getting? 0. What? 2 over 5. Okay, I'm having 0.4. Okay. So you come to your statement of financial position. So you still have your non-current assets here. Okay. Then you have the assets, which is, let's say, the plants, and that will give you 80 million minus the depreciation, that will give you 70 million. Okay. Then you come to the amortization of the direct cost, or you can.
Is 8.
It's 8. Okay, sorry. So that will be minus 8, and that will now give us 72. Okay. So the direct cost, you can just bring the direct cost over here, or you make it deferred direct cost. Okay, so these direct costs are deferred into the future, and that will give us 2 minus 0.4, and we are going to be having 1.6. Okay, if the rental has not been paid at the end of the year, then we make it to be the what? Then we make it to be a liability, but we assume that the rentals has been received at the end of the year, so there's no issue. This is how we go about what? About the operating lease. The operating lease, the lessor will still keep the asset and amortize it and depreciate it over the what? Over the useful life. Okay, over the useful life. So over the useful life. Okay, so that is it for this one. But let's come to where it is a finance lease. This is where the question will be if they want to ask you a question on the lessor accounting. Okay, when they ask you a question on the lessor accounting. So this one will be issues about, let's see, there can be a sub lease where the operating lease will come in. Okay, let's come to the finance lease. Okay, the finance lease, we are saying that the asset will now be transferred. Okay, we assume that the ownership, because the risk, maintenance, and the insurance associated with the asset will be transferred to the lessee. We assume that the lessee is the what? is the owner of the asset within the lease period. So what will happen is that the owner cannot claim what ownership over the asset again. So what will happen is that the lessor will now remove the asset from its books because the lessee will now recognize the asset. The lessee will now recognize the asset in its books as a right of use. So we de-recognize the asset. So the lessor will de-recognize the asset from its books. Okay, how do we de-recognize this asset? We remove the what? The asset at the carrying value because the asset will be in the carrying value, or the asset will be recognized in the books at the carrying value. So you remove it. Okay, sometimes the question can give you a fair value at the end. So if the lessor is using a revaluation model for the asset, then you first of all have to recognize the asset before you. So let's come to, I'll be using 2 here. So if the asset is carried under revaluation model, if they are using revaluation model for the asset, then you have to first revalue the asset. Revalue the asset before you recognize, before you de-recognize. So revalue the asset and de-recognize. So you revalue the asset first and de-recognize the asset. So there'll be an issue of revaluation loss or revaluation surplus. Then you remove the assets. Okay. What will happen is that in a return, okay, in a return, what will happen is that the person is supposed to be paying us what? The person is supposed to be paying us what? Renters. Okay. So what will happen is that these renters, we are going to be calculating the present value of the renters and recognize what we call lease receivables. So we de-recognize the asset and replace with what we call lease receivables. Okay. The lease receivable is just calculated like how we calculate a lease liability. Okay. So the lessee is going to be recognizing what? A lease liability and also the right of use. But we are also going to be recognizing what we call lease receivables, the money that the lessee has to pay us. Okay, the money that the lessee has to pay us, we have to replace our asset with what? Lease receivables. Okay, so we have the lease receivables over here. Okay, so he or she will recognize what we call the lease receivables. So we now recognize interest income. Okay, lease, okay, finance income. So recognize finance income. Why do we recognize finance income? Okay, we are going to be looking at that. So we recognize finance income because this is a finance lease. So we are going to be what? Discounting the what? All the rental payment together with any receivables, any options to what? To extend if it is exercisable. We are going to be discounting this. We are going to be present valuing this. So it means that we have also taken into consideration what? Time value of money. So if the person should have money and pay now, the person should have money and purchase the assets now or pay now, we cannot say the person will be paying what? The amount that will be paying over the lease period. But since you are not going to pay now, we have factored in what we call time value of money. So there is an interest component and the principal component in the amount that we are going to be paying. So we have to now separate the interest component and also the principal component. So the principal component will always be the present value. Then we have to be calculating the interest because the interest will be earned over the lease period. So every year we calculate the what? The interest. Every year we calculate the interest. So that is what we call the what? The finance income. Okay, that's what we call the finance income. So there can also be a profit or loss. Okay, there can also be a profit or loss. There can also be a profit or loss on the arrangement. How do we calculate the profit or loss? The question will give you the fair value of the asset, or they will give you the carrying value of the asset. Then you are replacing the asset with the lease receivable. So you ask yourself, the carrying value of the asset, is it lower than the lease receivables? It means that we assume that you are selling. So you are selling the asset at a value higher than what? Than the carrying value. So you have a profit there. So if the carrying value of the asset is 5,000, okay, and the present value of the lease receivables, so the lease receivables is actually, let's see, 6,500. So it means that asset that costs 500, you are now giving it out to the person at what? 6,500. So you are having a profit of 1,500. So the question will give you the question can give you fair value of the asset or the carrying value of the asset. You just compare that with what? with the lease receivables and see whether you are getting more or you are getting less in terms of profit or loss. Okay, so this is how we account for this one. We are going to be looking at how do we estimate the what? The lease receivables. Okay, this is a finance lease. So the lease receivables, how do we go about it? Okay, so the lease receivables, we are going to be having the fixed rental payment. Okay, the fixed rental payment. So there will be a portion of the rental payment that will be fixed no matter what, you'll be paying the same amount of money. Okay, so the question now is, I'm giving an asset to you for 5 years, which is a finance lease. And I'm telling you that you are going to be paying 50 million at the end of what? At the end of every year. So we have now agreed on interest rates because of time value of money. We have now agreed on what? On the interest rate, which can be the incremental borrowing rate of the what? Of the lessor, or the implicit risks that is being what? Included in the what? In the arrangement. So you are going to be paying 50 million at the end of every year. And this particular one is subject to what? 8% what? Interest. So it means that this particular amount that you are paying over the 5 years, if you should have cash today and buy the asset from us, you are not going to be paying the same amount that you are going to be paying over the 5 years. So you are paying 250 over the 5 years because you are keeping our money for a particular period of time. The value of the money or the price of the items will be increasing. So for us to buy whatever we want to buy today, if you should give us the money, we are factored in the increment of the price in the what? In the amount that we are going to be paying. So if I want to buy a bag of cement, which is 40 million today, but you are keeping my money, and they are saying that the price will increase by 8% every year, what will happen is that if I'm giving you the 40 million, I have to make sure that you pay the 40 million plus the 8% increase, so that if you give me the 40 million, I can be able to buy the bag of cement at the end of the year. So they always factor in what we call time value of money because of the increase in the what? In the price of items. So the incremental borrowing rate or the interest rate that will be given to you is just making a provision for the increase that will be in the price at the end of every year. Okay, so we can have this, then we just discount it. If you should have money and pay me right now, you are not going to be paying 250 over. You are going to pay money that is lower than this. So how do we find that one? We find the present value of all the money that you are going to be paying. That will give us the lease receivables if there's no other issues there. So what will happen again is that there can also be what we call a variable. There can also be what we call a variable payment. Okay, what do we call, or when do we have the variable payment? The variable payment will come in, which they will say that, okay, the included in the lease arrangement, there is what? There is 5 million, that is what? That is subject to what? Inflation what? Increase. Okay, so it means that that particular amount of money will increase when the inflation also what? Increases. So they can give you a rental, portion of it will be a fixed payment. No matter how the economy, you are going to be paying the same amount of money. It means that the lessor has not adjusted for the price increase before giving you that particular amount of money. Or they can also say that there's a variable payment which is going to be based on what? Inflation. So if the inflation increases, so they will give you a base for what? For determining the first one. So they can say that the variable payment is based on a 10% inflation. So whenever the inflation increases, it means that that particular amount of money will increase. So if the inflation is now 15%, you will now find 15% of that. That will now be the new amount. So there can be a variable payment over there. Okay. Then we can also have what we call, okay, if there is an option to exercise. So we can have an option to exercise if that is what? If that is exercisable. We only include the option when the lessor or the lessee is certain that they are going to be exercising the option. So if you are giving option, nothing has been said about the likelihood of the option being exercised, you will ignore. Okay, we can also have penalties. Okay, we can also have termination penalties, and this will also be included when it is what? It is probable that the contract or the lease will be terminated. So they can tell you that, okay, the lessee has the option to what? To terminate the what? The arrangement or the lease arrangement after 4 years. Okay, based on the current situations or based on the general increase in the price of items, the lessee is certain that the termination penalties will be what? Will be exercised. So if there's a termination clause and it is exercisable, the lease period will now be reduced to the termination period now. So that will be after 4 years. So it means that you're going to use the lease for only 4 years. So the asset will be used for 4 years. Then you return it back to the person. So if there's a termination clause there and it is exercisable, you have to reassess your lease period. It is 5 years, but at the end of the 4 years, we are going to terminate it. So it means that we are now using the assets for only 4 years. And the termination penalties will only be included when it is it is certain that it will be exercised. Okay. Then we can also have what we call the residual value. Okay. So we have issue with the residual value. So the residual value can be guaranteed or unguaranteed. Okay. So the residual value can be guaranteed or unguaranteed. What do we mean by residual value? The value of the asset at the end of the lease period. How much can you sell the asset at the end of the lease period? That is also a cash flow coming from the assets. So we only present value the cash flows that will be coming or the cash flows that will be arising from from the lease or from the use of the assets. Okay, so the residual value is also a cash flow that will be coming at the end of the lease period. So we also factor in this one. For the lessor accounting, we use both the guaranteed and also the unguaranteed residual value. The guaranteed is the one that is being guaranteed by the lessee. The lessee is telling you that at the end of the lease period, I'm going to be paying you or I'm going to be giving the asset that will value at this amount. Okay, so if you are calculating the lease liability for the lessee is going to be including the guaranteed residual value. But we are talking about the residual value in total. The lessee is saying that he's going to be giving you this one. He can guarantee you this amount. But in the market, the total value is this amount. So if you take this from the lessee, you also take the remaining one from the asset. So we have the total residual value, guaranteed and unguaranteed. This is what we do. So we pick the fixed rental payment. We have the variable payment if there is any. We have the options if it is certain that it will be exercisable. We have the penalties when it is certain that it is going to be exercisable. We include it. Then we also include the residual value. Okay. How do we calculate the lease liability? I said the lease liability, the lease receivables. Okay. The calculation is the same as the lease liability. Okay. So someone is paying you 70 Ghana at the end of the year, and you are factored in 8% increment in general price levels. So the question is, the person should have money and pay you today. How much will the person be giving to you? Or how much? What is the principal always? And what is the interest? The amount that the person is going to be paying to you has principal component and then the interest component. The principal will be paid now. If the person have money, the person will pay the principal now. So we want to know the principal amount. The interest will be paid over time. So let's separate the interest component from from the principal component. So we try to present value this one. So we have the years, the cash flow, the discount factor, which will be that one. Then we have the present value. So we find the present value. Then we now have the lease receivables. Then we now account for the lease receivables, like how we calculate or how we account for the lease liability. We calculate rental. We have the rental income. We have the finance income. Then we have whatever we are going to be having over there. And the rental payment is also depends on how we are going to be doing it. The question can say that the rental payment will be in arrears or will be in advance. How do we go about it? We pick a question, then you see how we look at the advance payments and also the payment in arrears. If they say the payment is done in advance, it means that the payment is done at the beginning of the arrangement, at the beginning of every year. So before you even take the asset, you have now paid a certain amount of money. So that particular amount of money is not part of the owings. We only present value the owings. So what is the amount that you are here to pay? You only present value. So the first payment is not present value because the present value of that is the same as that amount, and that amount you are not owing. You have already paid amount, that particular amount. So it's not part of the owings that we are going to be calculating. So we pick a question and we look at how to go about that particular one. So let's pick some tutorial questions and see what we can do. Okay, let me talk about this one before we pick this question. Okay, so there can also be, I've mentioned, a variable what payment. This particular variable payment should not be based on any performance condition. Okay, this one should be based on something that the entity has no control over, and that is the inflation. Okay, that is the inflation. But if it is based on something that the entity has control over, it means that the entity can decide not to meet that particular what threshold. So they can give you a variable payment that will be based on the output level. That is a performance what? That is a variable payment based on performance consideration. The entity can decide not to meet that particular performance target or to meet it. So at the date of the estimating the lease receivables, we don't include those variable payment that are based on what? Performance conditions. So we only wait till that particular performance condition has been met, then we recognize them as income in our profit or loss account. So they can say that the company is going to be paying 2 million in addition to the renter when they are able to produce above a particular unit. Okay, that one is something that is based on on a production level. It's something that is based on a production level, which can be achieved or cannot be achieved. So we only recognize that particular one when the performance target has been achieved. Okay, but the variable payment over here is based on something that the entity has no control over. And it's not going to be it's not based on performance condition. It's based on the inflation rate of the economy. So you have to pay attention to a variable payment that will be based on condition, or that will be based on the performance condition of the entity. The lessor can only recognize that when the lessee has achieved that particular performance obligation. When the lessee has achieved that particular performance obligation. Okay, so what will happen is that we are saying that if we are able to make a profit of 10,000 at the end of the year, we are going to pay people bonus of this amount. Okay, what is the assurance that we are going to make profit? So we cannot make provision for that unless we have a past experience. Okay, we have a past experience that shows that every time that we say this, we end up making the profit, or we end up exceeding our profit level. For that one, you can make a provision. But if nothing is being known about that, what will happen is that you only pay the bonus at the end of the year when the profit target has been achieved. So the same thing applies to the variable payment over here. So let's pick the question number 1 there. Then we look at how we go about we look at how we go about the issues of the. Okay, so we look at how we go about the issues of the lessor accounting. Question number 1.
Okay, so question number 1. At the beginning of the current year ending 30th April 2023, management of Akuma PLC leased a specialized equipment to Sophia PLC for annual rental of 5 million Ghana cedis. The specialized plant has estimated useful life of 10 years, and the lease period is 8 years. The arrangement also requires Sophia PLC to maintain and insure the equipment over the lease period. Sophia PLC is also expected to make additional payments of 0.6 million Ghana cedis at the end of each year. At the end of each year, that production output exceeds a defined output. At 30th April 2023, Sophia PLC's production had exceeded this defined output target, and the additional payment was made according to Akuma PLC. The open market value of the asset estimated at inception of the lease is 1.4 million Ghana cedis, of which 0.5 million is guaranteed by Sophia PLC. Both Akuma PLC and Sophia PLC incurred initial direct costs of 0.4 million and 0.2 million. Implicit interest rate in the lease is estimated at 8.98% required. In line with IFRS 16 leases, explain how Akuma would account for the above lease in its financial statements for the year ended 30th April 2023.
All right, so yeah, thank you. Please, they cannot give you figures. I keep on saying they cannot give you figures and ask you to explain, and you'll be writing English. Okay, the explanation that they're asking you is how they should account for this one. What figures should be taken to what the profit or loss and those ones. So you have to do your calculation. Whatever figure that will be taken to profit or loss, then you use the figure to explain what will happen. Okay, so this one, the question is even telling you that in line with what IFRS 16. This is a lessor accounting. So we are going to be doing this for Akuma, who is the lessor here. So how much will be taken to profit or loss? How much will be taken to statement of financial position? That's what they're asking you to say. Okay, so you have to do your workings. Okay, let's come here. How is this particular operating lease or a finance lease?
Finance lease.
Okay, so you can see that they have added a statement to let you know that this is a finance lease. They say the Sophia PLC is the arrangement requires Sophia PLC to maintain and also ensure the equipment over the lease period. Okay. How many years is the lease period? The lease period is how many years?
8 years.
8 years.
Okay. And the rental will be paid for. How are we paying the rentals? Is it in arrears or? How are they paying the rentals? That one is it defined for us?
At the end of the year in arrears.
Okay, let me. Can we get that one somewhere? If nothing has been said, it will always be in arrears. If it is in advance, the question will tell you. So I'm not sure nothing has been done over there. Sophia PLC is also expected to make additional payment of 0.6 million at the end of each year that the production. So that is based on so this one is going to be in arrears. If nothing has been said, it will be, so at the beginning of the current year end, management of Akuma PLC leased out this one for annual rental of 5 million. The special plant has a useful life of this and the lease period is 8 years. The arrangement also requires this and this. Okay, this will always be in arrears. If nothing has been said, it will be in arrears. Okay, so what are we having here? So there will be a rental payment. So we look for what we are going to be using to calculate our lease receivables. So we have the rental to be 5 million for what? 5 years, isn't it? 5 million for 5 years. Is that correct?
Yes, sir.
The total period
Okay. What is the disc? Is it 5 years or 8 years? Sorry.
is 8 years.
Okay. So that will be 8 years. Okay. The discount rate is what? 8.98. Are we correct with that?
Yes, perfect.
Okay. So this one, if you are not giving the interest implicit rate, you use the what? The borrowing rate of the what? Of the lessor. You use the borrowing rate of the lessor because the lessor is the one that is going to be recognizing what? The lease receivables. So he is going to be doing the arrangement based on his borrowing rate. But if it is the lessee, you use the borrowing rate of the lessee. So sometimes they can give you the implicit, or the question will tell you that the implicit rate in the lease is not yet available or is not yet determined. So the entity is having a borrowing rate of that one. You use the borrowing rate at the date of the transaction. So we know that year 1 to year 5, okay, the lease rentals will be received for what? 5 years. So that means year 1 to year 5. Okay. So this is what we call annuity, because you are going to be receiving an equal amount at the end of every year or at the end of a particular period. That's an annuity. So if you are going to be paying 5 million at the end of every year, you are paying an equal amount. Whenever you are paying an equal amount at a particular interval for a particular period, we call that one annuity. Even if you are paying at the end of every month, since it's an equal amount, it will be called an annuity. So we are going to be paying, what am I saying, the 5 years? Okay, so we have 0 to 8. Okay, 1 to 8. So you are going to be paying the rentals for what? For 8 years. 5 million at the end of every year for 8 years. That is an annuity. So we use annuity factor. Okay, so let's calculate the annuity factor. How do we calculate the annuity factor? The annuity factor is calculated as 1 minus into bracket 1 plus R exponent negative N divided by the R. Okay. For you, they are going to be giving you this in the exam hall. They will give you the annuity table. Okay, they will provide you with the information on the discounting factor and also the annuity factor. What are we having? 1 minus into bracket 1.0898 exponent negative 8 divided by 0.0898. What are we having?
5.54.
Okay, so we have 5.540. Okay, let's come to, would there be any other payments? Would there be any other cash flow from the arrangements? Will there be any
Yes, the
other
variable
cash flow?
payment
Okay, the variable payment will not be, that one we don't discount.
0.6 million.
We only recognize it when the what? When the performance target has been achieved. So that has been achieved. So we only recognize it as an income at the end of the year. So it will not be part of our what? Our first what estimate. So these one, the people, they are not obligated. Okay, you don't have the rental payment, you don't have any choice. You are going to be paying. You don't have any choice. So we only factor in those ones that you don't have any choice to what? To avoid the payments. Okay, but for the variable payments, they have the obligation to avoid it. Okay, so at the start of the arrangement, there's no obligation to pay that particular, or there's no obligation to receive that amount of money. So we only discount those amounts of money that we are obligated to receive. So the variable payment will come as an income, as other income in the statement of profit or loss when it has been what? It has been achieved. Okay, let's come to the other one. Do you have any residual value here? Is there any issue of residual value?
I
No,
think it's
sir.
0.5 million.
Now we use both. We use guarantee and unguaranteed. Okay, the 0.5 is the one guaranteed by Sophia, but the total residual value is what? 1.4. Okay, so you use the total, both, which is a guarantee and unguaranteed. But the one that the lessee is telling us is 0.5. They can give us 0.5 out of that. But the total amount that we are going to be receiving is 1.4. So we have the unguaranteed to be 0.9 and the guaranteed to be 0.5. When are we going to be receiving these amounts? When are we going to be receiving these amounts? Okay, this amount will be received at the what? At the end of the lease period. Okay, so this is just a one-time payment at the end of the lease period. So if you like, someone can separate this one. The person will do guaranteed and unguaranteed, please. That is, you are using time. So just use the two. We use the total. If you are doing the Lessor accounting, we use the total residual value to what? To estimate our what? Our lease receivables. So we are going to be doing, this is just a one-time payment. So this is going to be using the discount factor. So it's a one-time payment. So we have 1 divided by 1 plus R exponent n. So that will give us 1 over 1.0898 exponent 8. What are we having?
0.503.
So 0.503. So let's now multiply and have our figures there.
0.704.
The last one,
Yes, sir.
0.704.
704.
Okay, let's just make it 0.70. Okay, the first one is what?
27.7.
Okay, 27.7. So what will be the total?
$28.4.
Okay, so this is our lease receivables. Initial recognition. This is our lease receivables. At the date of the arrangement, we are doing this at the start, which is the initial recognition. So how do we recognize this particular transaction at the date of the arrangement? We are going to be recognizing the lease receivables of 28, which is the principal component of the arrangement. Okay, the principal component is the amount now. So the difference between this one, which will be we are going to be paying 40 something million. Okay, 40 something million. So the difference between the principal and then the total amount that will be paid over the lease period is the interest. That's what we call the time value of money. But the interest will now be what? End at the end of every year. So we'll be earning the interest at the end of every year. So the initial recognition, if we have any value about the assets, okay, if you have any value about the assets, what we do is that if you have any value about the assets, we replace the asset value by the what? By the lease receivables. Okay, so let's say the value of the asset in our books, the value of the assets in our books is 25 million. Okay, what we do is that we have also incurred initial direct costs. Can you see that there's an initial direct cost there?
Yes,
Why is the initial direct cost incurred by the lessor?
0.4.
Okay, so what we do is that the 0.4 will also be part of the asset. So what we do is that if you want to de-recognize, we add a 0.4 to the what? We add a 0.4 to the lease receivables to have that amount. Then we now match it against this one. Okay, we now match it against this one to have our gain. Then what will happen is that we now reclassify the transaction cost, which is the direct cost, to be an asset. Then we also amortize it over the lease period. So if we have the current value of the asset, then you have to now subtract to get a gain. You'll be having a gain of 3.8 or something that will go to profit or loss. Then you now reclassify your transaction cost and amortize it. Okay, you now reclassify your transaction cost and amortize it. Okay, but this one, we don't have any information about the fair value of the asset or the current value of the assets. So what we do is that even if there's a fair value of the asset, because the question 2 is talking about something like that. So if there's a fair value of the asset, you first of all fair value the asset to recognize revaluation loss or gain before you now de-recognize the asset using the lease receivables to recognize additional gain or loss on the transaction. Okay, so that's how you go about it. But there's no issue about that. So we are going to be having lease receivables. So we are going to be debiting our assets, which is the lease receivables now, and we also have direct costs at the end of. So at the beginning of the year, which will be December, which will be January, at the beginning of the year, January. So at the beginning, the entity is going to be having a lease receivables. So lease receivables, we are just doing it at the beginning of the year. That will be 22.4. Okay. Then we have the direct cost, which will also be classified as an asset at 0.4. Okay. So we are going to be doing this at the end of the year. What will happen at the end of the year? At the end of the year, you know that our interest for the first year supposed to be end, isn't it? Because the interest is for a whole year. So we have done a full year. So we have to recognize the interest component on the arrangement for the first year. Okay. After that, then the people will now pay 5 million to us. So what will happen is that at the end of the year, which is going to be 30th April. So let me just make it at the end of the year. At the end of the year, what will happen is that we are going to be having our lease receivables here. Okay, so we have our lease receivables. We now account for our lease receivables. So we have the balance brought down to be 28.4. Then we have what we call a finance income. Okay, how do we calculate the finance income? Okay, the finance income will just be the 0.0898 multiplied by so we have used the present value to what? We use 8.98 to present value this. So it means that every year we have to be increasing it. We have to be compounding it. So you multiply by the 28.4. What are we having as the finance income?
That gives us 255.03.
Okay. What I will say is that the finance income is equivalent to finance cost. Okay.
Sorry, 2.55.
Okay. So the finance income is equivalent to finance cost. If it is a lessee that is doing this, the lessee will be calling this particular one what? A finance cost. But this is now the lessor. The lessor, this is now an income to him. So that will be, this will be named what? A finance income. At the end of the year, what will happen? The renter will be paid, isn't it?
Yes, sir.
If the rental is being paid, what will happen? It will reduce the what? The lease receivables, isn't it? The lease receivables is the amount that the lessee is owing us. At the end of the year, the lessee has paid 5 million. What will happen? It will reduce the what? The debt that the lessee is having with us, isn't it? Okay.
Yes, sir.
So you reduce your lease receivable by this amount. What are you going to be having as the net amount?
25.95.
25.95. So you have the 25.95. Okay, if you like, you can separate the two as portion of it will be a non-current asset and portion of it will be a current asset, but that is not the issue over here. So you can actually separate these two. How do you separate these two? Okay, you just calculate for, so I'll do the separation. So I want us to separate this one with what? With non-current asset and also the current asset, so that if we go to the lessee accounting, it will not be difficult for us. Okay, what will be the interest? What will be the interest payment for the next year? What will be the interest payment for the next year? Okay, or the finance income for the next year? That will be 0.098 multiplied by this figure. What are we having?
2.33.
Okay, that will be 2.33, isn't it? Okay, but how much are they going to be paying at the end of the year?
5 million.
Okay, you see, this 5 million comprise of both the principal payment and other what?
The interest.
Okay, so what would be, if 2.3 is the interest payment, what would be the principal payment there?
That's 2.6.
Okay, that would be 2.7.
2.7.
Okay, so this particular principal payment, okay, the principal payment, we are not going to be doing anything for the principal. The principal will be there at the beginning of the year to the end. So we can say that the principal payment will be done at the beginning of the following year, or it will be done in the next year. It is the interest that we are going to be paying, or it is the interest that will be earned at the end of the year. So what you do is that you find a principal payment. This particular principal payment will be classified as a current asset. So you have the lease liability, the current asset will be the principal payment. Then your non-current assets will now be this is supposed to be the total lease receivable. So we now subtract the principal payment from that. So 25.95 minus 2.7. So if you put the two together, you still be having the same value. But if you cannot do this, please just show your lease receivables as what? As 25.95, which will be a non-current asset, because this is going to be for additional 7 years. Okay, so let's come to our, so what you do is that when you want to separate it as current and non-current, mostly it is a principal amount that is being treated as what? As the current one. How do you find that? You find your interest for the next period, then you subtract it from the what? The rental payments. So the interest, that is the interest component. What will be the principal component? You calculate that. Let's come to the statement of profit or loss. What are we going to be showing? Okay, let me come to the amortization of the direct cost first. Okay, amortization of the direct cost. Okay, that will be 0.4 divided by 8, isn't it?
Oh, yes, sir.
Okay, so I'm having 0.05. Is that correct? Okay.
Yes, it is.
So let's come to statement of profit or loss. Okay. I'm going to be having amortization of the direct cost to be, so let's do this in million, 0.05. Then I'll have other income. What do you think will be the other income?
The variable payment
Okay,
of 0.6.
that will be 0.6. Then we now have the finance income. Okay, so the finance income will be 2 point what?
2.55.
Okay, then you go to your statements. Okay, this one they say you should explain. So you can say that the company, in the statement of profit or loss, the company should show a net amount of this. So you can just find a net amount of this, which will be 2.55 plus 0.6. Then you supply the 0.05. Then you show, they say that the entity should show a net income of this amount. How do you calculate it? You put it in a bracket. But if you can show the extract, fine. But they are asking you for explanation. So after doing all these things, you now use the figures to tell them which figure should go to profit or loss and which figure should go to what? Statement of financial position. So for the year ended 30th April 2023, a net amount of what? Net amount of what? What will be the net amount here? A net income of 2.55 plus 0.6 minus 0.0.
3.10.
Okay, so a net income of 3.10 should be taken to profit or loss. And how do you calculate this? You show it in a bracket after that one, after the figure, you show it in bracket there. Or you can say the entity should charge an amortization of the direct cost, which will be amortized. You have done amortization already to profit or loss as an expense. The variable payment, which has been received because the production has exceeded the output level, should be treated as an other income of 0.6. Then we have the finance income of 2.55. That will be the figures that will go to statement of profit or loss for them. If you come to statement of financial position, the entity should show what? A lease receivable as a non-current asset of what? 25.95. That is if you cannot separate the two. But if you can separate the two, the entity should show a lease receivable as a current asset of 2.7 and what? The 25.95 minus what? The 2.7. Because at the end of the day, the total receivable that should be shown is 25.95. But we are just splitting these as current and the non-current assets. Okay. And the entity should also show a deferred direct cost of what? 0.4 minus what? 0.05. That is what you are going to be telling them. Okay, but if you can show the extract, fine. If you cannot show them, calculate the figures and now use the English. So that's using the figures to now tell them how the figure or which figure should go to statement of financial position is what we are saying to be the explanation. Okay, or even if you are talking about this particular arrangement should be accounted for as a lease, as a finance lease under Lessor accounting, that is fine. But you don't have to come and tell us what the standard is saying about the Lessor accounting, that you should present value this to find the value of the lease receivables before you come and find the present value. No, just go straight to the present value, calculate it, get the figures, use those figures to tell them which figure should go to profit or loss, which figure to go to statement of financial position. That's what we call about the explanation. They cannot give you figures and you'll be writing English that you are telling them how a transaction should be accounted for. No. Unless you don't have figures. That one you can use English in your write-up. Okay. I saw a hand up. Yeah, Senior Evans, your hand is up. Okay. So this is basically about the Lessor accounting. Okay. We will be doing the lessee accounting and probably the the foreign lease. Okay, we'll be doing all of them, the foreign lease and then the lessee accounting, all of them next week, same time, same venue, and the last one will be the modification of this one. So what we are going to be doing is that, okay, what we are going to be doing, the standards that we are going to be doing are done, will be the IFRS 16, which is leases. Okay, then we have the IFRS 9, which is financial instruments. Okay, so we have the financial instruments. So financial instruments. Then we have the IS 33, which is earnings per share. Then maybe if we are not able to do this one in a normal class, which is the revenue, we bring the revenue to down. So but basically this is the one that we are going to be looking at down. Okay, so that is it. Okay, so that is it for that one, and that is all. So we have done the Lessor accounting. We have done the Lessor accounting, and we say that the Lessor accounting it's just like how we calculate the lease liability. But this one we are doing it for what? For the Lessor. So this will now be an asset to the Lessor. The same thing, we use those things and now what? And now account for this particular one. All right. Okay, so that is it. That is it. And okay, I'm sure. Please, can you explain how it moved from this one to how it moved from what? The I-17 to IFRS 1. The only thing that has been added is what? Is the lease accounting. The lease accounting was not part of the what? The 17. So they just added the lease accounting. That is it. Okay. So that is the 17 is no longer available. But for the 17, what we have been doing is that we have been using the actuarial method to calculate the lease, and also we have been using the sum of digits here method to calculate the finance income and also the interest. But what happened is that the sum of digits here method is no longer here. So we are now using the actuarial method where you have to find the present value of everything. For the sum of digits here method, what we do is that we look at the cash price of the item, then we look at the amount that you are paying. The difference between the two will give you the what? The interest income or maybe the finance cost. So you now share the finance cost based on the sum of digits here method. But that particular method is no longer applicable. Okay, it's no longer applicable. What goes into the statement of financial position is the finance cost, is those portions that are yet to be consumed. So I say finance cost is a direct cost. The direct cost we have consumed 0.05. So remaining one will be 0.35. That is yet to be consumed. That will be treated as a deferred direct cost. That will be 0. So the lease liability, the people are still owing us this amount at the end. So they are owing us 28.4. We have charged interest of this one. So the total amount on the account should have been this. They have paid 5 million. So it means that they are owing this amount. So the lease receivables will also go to the statement of the financial position. Any other issue? If there are no other issues, and if you have any question, you can, or if you have any clarification, you can just WhatsApp me on this number. Okay, so that is it. I'll see you guys in the financial reporting. I'll see you later in the morning, corporate reporting in the evening. Thank you all for coming. I'll see you guys.
Hello, sir.
Yes, please.
Sir, please, can we have the notes?
The note on
Today's lectures.
no, I won't share a question. So the question has been shared already.
Okay. Thank you, sir.
All right.